Let's set the stage. The year is 1999, and Wall Street is completely drunk on decaf lattes and optimism. Investors are caught in a manic financial euphoria with seemingly endless capital to spend. The internet is still a glitchy, screaming dial-up modem, but the market consensus is that it will soon facilitate every transaction on the planet. If you walked into a venture capital firm and whispered a domain name, investors reacted like a dog hearing a chip bag open. You didn't even need a working business model. We had companies famous for their sock puppet mascots burning through investor money to physically ship 50-pound bags of dog food across the country at a massive loss. No one asked about profits. The only metric that mattered was the burn rate. Revenue was treated like a myth, and aggressively spending cash was viewed as the only way to prove you were scaling. People were not investing in real, functioning businesses. They were investing in pure vibes, creating a dangerous vacuum of basic business logic. Enter Webvan. Their pitch was genuinely intoxicating. They looked at the tedious chore of grocery shopping and promised to deliver your fresh milk and eggs with the speed and accuracy of a military strike. Investors handed over more than $1 billion to the startup before it had a single customer. They immediately began building a futuristic empire. They bought huge fleets of delivery trucks and spent hundreds of millions of dollars constructing hyper-optimized automated warehouses. But this launch phase had a fatal flaw. Wall Street funded the ultimate delivery machine without anyone checking if consumers in 1999 actually wanted to buy their groceries on a computer screen. This flowchart shows Webvan's insolvency. Securing funding feeds directly into build infrastructure, bypassing customer demand. Massive red outflows drain from infrastructure, representing their astronomical burn rate. Zooming in, a massive cost bar dwarfs the tiny revenue bar per order. They ignored basic unit economics. By blindly assuming venture capital would subsidize their operational overhead indefinitely, Webvan guaranteed its own collapse. At the exact same time, Jeff Bezos was building Amazon with a completely opposite philosophy of brutal, relentless frugality. Amazon started with a highly strategic product, books. They were standardized, easy to ship, and crucially, they didn't rot in a warehouse. Looking at this corrected flowchart, Bezos followed the right order of operations. He proved the consumer demand first, which flowed into generating revenue, and that finally unlocked the ability to build massive logistical infrastructure. By refusing to build the empire before validating the demand, Amazon insulated itself from the need for a constant drip of outside capital. In March 2000, the Nasdaq hit an all-time high, the champagne flowed, and then the market quietly broke. The wild optimism curdled into fear. Investors suddenly stopped caring about massive scale and panicked over the complete lack of revenue and profitability. For Webvan, the cash spigot shut off. Without venture capital to fund their massive overhead, they couldn't support their empty warehouses, and the company rapidly collapsed. The dot-com crash wiped out over $1.7 trillion in market value, cementing Webvan as the ultimate punishment for ignoring financial gravity. Fast forward to 2017, when the same vision that bankrupted Webvan became the centerpiece of the modern grocery economy. Jeff Bezos finally decided to conquer the grocery industry, spending $13.7 billion to acquire Whole Foods. Instead of building billion-dollar automated warehouses from scratch, Amazon instantly turned existing physical stores into local distribution nodes. Bezos achieved Webvan's exact dream by leveraging the very physical assets that Webvan thought they were replacing. Scaling expensive infrastructure before validating customer demand is a guaranteed way to vaporize $1 billion. You can never build the infrastructure for the future if you cannot survive the financial realities of today. Thanks for watching Irony Economics. If you enjoyed this look into the madness of the markets, hit that like button, subscribe, and let me know in the comments which multi-billion-dollar disaster we should decode next.